Hello, investors. In one of our earlier episodes, we talked about how asset allocation helps build a strong and balanced portfolio. Now, in this video, let's dive deeper into how diversification within a single asset class, like equity, can further strengthen our portfolio. In equity, we invest across various sectors like healthcare, technology, consumer goods, and more. Diversification simply means not putting all your eggs in one basket to minimize risk and improve portfolio stability. For example, if tech stocks are down, other sectors like healthcare or FMCG may still perform well, helping balance your overall returns. Our AI-driven model, All-Rounder, scans 46 custom indexes to pick stocks across sectors and market caps. The model ensures diversification by selecting not more than 2 stocks per sector and also ensures no single stock exceeds 15% of your portfolio, keeping your investments balanced and secure. To sum it up, here are some benefits of diversification. Not relying on a single stock or sector to generate returns, minimizing the impact of any negative news on a stock or sector, ensuring that no single market event can significantly impact our portfolio. Hope you understand why you should not put all your eggs in one basket. That's all for now, but remember, stay curious, stay smart, and never stop learning. Thank you for watching and see you again next time.